Chapter 18, Part 2, we're going to look at treasury stock and retirement of shares. Now, the treatment of treasury stock has changed, and I think it's a better way of doing it than it used to be. Now, accounting for treasury stock. Purchase of treasury stock is viewed as a temporary reduction of shareholders' equity. Cost of acquiring the shares is temporarily debited to the treasury stock account. Shares are considered to be issued but not outstanding. Now, this is the old method. Purchase of treasury stock and its subsequent resale is considered to be a single transaction. The approach to accounting for treasury stock is referred to as the cost method, which means you record it based on what you paid for it. And remember, there can never be a gain or loss for the repurchase and sale of a company's own stock. So now let's take a look at an example. In 2021, my corporation had 170,000 shares of $1 par common stock issued at a fair value of $34. The company had the following transactions during the year. They reacquired $1 million at $32.50. They required another $1 million at $36. They sold $500,000 at $35 and then sold another $500,000 at $28. So let's take a look at how we record this under the old method of how we treated treasury stock using the cost method. Well, when we reacquired the stock, the rule is you ignore par value. So you're going to go treasury stock times what you paid for it, and then you're going to credit cash. Now the other entry would be the same. You take the treasury stock, number of shares times $36, and cash. Now, what happens when you sell them? Well, the resale of treasury stock is viewed as a consummation of a single transaction begun when the treasury shares were purchased. Allocating the cost of the treasury shares occurs when the shares are resold. Again, there can be no gain or loss, and if the sale price is less than the purchase price after depleting paid-in capital treasury, then you must debit retained earnings. So let's take a look at what that looks like. So we sold our 500,000 shares at $35. So, rule, when you sell, you must take out the stock at the amount you paid for it, which was $34. We're going to use the FIFO method, which is the first in is the first out. So, we're going to take 500,000 times $35. Treasury stock, 500,000 times $32.50, which is what we paid for it. Paid in capital share repurchase is the difference is going to go to that account. Now, rule, if you sell less than you paid, then the difference goes to paid in capital share repurchase until zero. Then you treat it as a reduction to retained earnings. So our cash is 500,000 times $28. Our treasury stock comes out again at $32.50. Our paid-in capital share repurchase, we take away the $1,250,000, and the difference is the plug is going to go to retained earnings. Now we're going to take a look at the same example, but what happens if we treated them as retired? So let's take a look at this. Same problem, and now what we're going to do is treat them as if we retired them and then reissued them. So on January 1st, we reacquired 1 million shares for $32.50. Rule, you must take out of common stock and paid in capital based on the fair value when issued, which is $34. So we would do common stock times the par value, 1 million shares times $1. We do pay-in capital in excess of par, which is the $34 that it was originally issued for minus the $1 par times 1 million shares. And the cash is going to be $32,500,000, which is 1,000 shares times $32.50. And the difference is going to go into paid-in capital share repurchase. That's a plug. Now what happens the next time we reacquire? we would do this. The rule is you must take out of common stock again and paid in capital based on the fair value when issued, and in our example again is $34, and any excess over the original issue price plus balance in paid in capital repurchase must be debited. So now let's look at those journal entries. Again, we do the common stock, we do our cash, paid in capital in excess of par, we take out the amount that we have sitting in paid in capital share repurchase, and the difference is going to go to retained earnings. It's a plug. Okay, that's how that works. Now, what happens we now turn around and sell the shares? Now that's a lot easier because it's like when we issued them originally. So what we're going to do is we're going to go cash is going to be $500,000 times 35. Common stock is going to be $1 times the number of shares, and the difference is going to go into paid in capital in excess of par. When we sell them again, do the same entry. You're going to do the cash is going to be times what you received. The common stock is times par, and paid in capital is always the plug. Now, one other thing that can happen is what happens if we have treasury stock and we decide we don't want to fool around with this anymore. Let's just convert it to retired stock. So here is our example. We decide right now we have common stock, 200 million shares, and we have treasury stock of 4 million, and we want to convert that. We want to get rid of that line item on our balance sheet. So what do we have to do that? Remember, this is considered a change in accounting principle and would be treated retrospectively, which means we'd have to go back and change 3 years, which is what usually appears on the financial statements. So this is what we look like right now. So what we have to do first is we have to go common stock, 4 million shares times $1. Paid in capital in excess of par. Well, how did we get that? What we do is we take and come up with the average for the paid in capital excess of par by taking the 800 million and dividing by our 200 million shares. And so we get $4. Now, treasury stock is going to go away, the 25 million. And you notice the common stock's going to go away because we're crediting that account, and paid in capital is going to be reduced. So common stock and paid in capital will be reduced. Common stock now will be 194 million, and additional paid in capital would be reduced by that 16 million. And treasury stock, that 25, and remember, treasury stock always has a debit balance. That's why I have to credit. That line would go away. And the difference would go to retained earnings. And that concludes this presentation for part 2.